3, 2, 1. Welcome to the show.
All right.
All the times we've been doing this, and I still can't figure out what buttons to push.
Dude, 15 October. I don't know where the time goes, but
Yeah, I know. It's
ticking by.
It's going to be Christmas tomorrow.
I know. A lot of crazy things this week. Really a continuation of last week. All kinds of data that came out. JOLTS job openings survey was last week. That day was actually the bottom of this correction that we're in right now. And then every couple of days since then, we got some kind of data, PPI, CPI, all kinds of different data points that are pointing to higher inflation, which means the Fed should continue to raise rates. And yet the market finds a bottom, and Thursday and Friday, market was rallying until about 1 o'clock on Thursday.
Yeah.
It was down Thursday a little bit, down Friday a little bit, but the fact that all the stuff
week, right?
Up for the week, CFON was up for the week.
Yeah.
But amazing that it hasn't rolled over, given all the really hot inflation data and of course the Hamas Israel thing. It's unbelievable. But there's all the supporting technical levels, and going into the fourth quarter of the third year of the presidential cycle, like there's all these reasons why it should go down and all these reasons why it should go
up. And we're just stuck in the middle.
Yeah.
All right, what do you got this week, man?
All right, so we're going to take a look a little bit closer at the this week's events. I got a really well thought out comment. I don't remember if we got it in an email or what, but a really well thought out comment about why this person is in the G fund, and we're going to kind of go over that and pull it apart a little bit. And then I got a few other questions from people that are subscribers to the site, so this will give you guys a taste anyway of what people are talking about and asking us about if you're a subscriber to the site, and then the TSP fund charts. So, like we said, the JOLTS survey came out on October 3rd, and it was way, way harder than expected. So there were way more job openings than what they expected. The unemployment rate is definitely one of the key things. We've been talking about it quite a bit. We've shown charts from the FRED, that cite the FRED. Until unemployment starts ticking up, the stock market keeps going higher. But once unemployment does really meaningfully start ticking up, that's going to be when the recession begins and all that. But anyway, October 3rd really marked the bottom of the correction that we've had since the end of July. And we get this really hot JOLTS number, and the market rallies, which is counterintuitive. And then a couple days later, that weekend, Hamas attacks Israel, the biggest incursion into Israel since the Yom Kippur War. Oil spikes 4%, and then still the next, so that was over the weekend, and then on Monday, the market rallied big, right? Nobody would have thought that. And then this week, PPI comes out, way higher than expected. So the costs, the input costs to producers are much higher than what they expected them to be. So again, another data point that inflation is still a big problem, so that the Fed should continue to raise rates, and still the market rallies. And then Wednesday, or I guess it was Thursday, whatever, October 12th, CPI comes out, 8:30 on, I guess it was Thursday morning, higher than expected, and the market rallies until 1 o'clock. And I don't know, I still can't find what happened at 1 o'clock, but at the tick, 1 o'clock, the market started rolling over, and it finished not at the bottom of the day's range, but was down a little bit on Thursday, and then Friday was down a little bit again. But unbelievable strength over the course of the week, given all these inputs for the week. So that's what happened on the market this week. I don't think anybody would have thought that it would have stood up as well as it did, but that's what happened. So here was a comment that I was talking about. So good morning, guys. I think your comment on Elliott Wave sums up what many of us TSP investors are routinely concerned with. So what I said in one of the newsletters, Elliott Waves is not designed to be used to make day-to-day reallocation decisions. It helps us keep short-term market volatility in perspective. So that newsletter was talking about long-term Elliott waves. You can, and I'm going to show you why it's important to use Elliott waves to actually make reallocation decisions. But the long-term Elliott waves helps us keep the short-term market volatility in perspective, because if you're, if you're near the top of a 1, 3, or a 5 wave, in a bigger chart, you would expect that pretty soon it's going to roll over. And if you're, at the bottom of a 2 or a 4 wave, you would expect that pretty soon the market's going to start moving higher. So what we talked about on that newsletter was different time frames of Elliott waves. So with only 2 allocations per month, we tend to look at the 20 and 50 meter targets that influence decisions over periodic market oscillations. Given the uncertainty of the past weekend's events and the market repercussions that they bring, it seems that holding in the G fund is the most prudent course of action until all the major parties, U.S., Israel, Saudi Arabia, Iran, and its proxies, decipher their course of action, right, whether it's Connecticut or dime, and proceed. Oil prices will move upward for as long as this goes on. There's still the ongoing war in Ukraine, uncertainty in the House over speakership election. Fed has one more possible rate hike. Other than that, all is, as the Russian phrase goes, clear as an orange. This is typically where we begin looking towards the start of the fourth quarter market upswing, now that we've passed the September lull, but this looks like things will be put on hold until the situation begins to clear. So until then, I'm holding in the G fund, right? Am I wrong to view things this way? No, absolutely not. You're not wrong to view things that way. That is what's actually happening those are a lot of the macroeconomic conditions and certainly geopolitical events that are going on right now. And there's nothing wrong with holding in the G fund. Absolutely nothing wrong with it at all. You're making 5% annualized. So people look at that and they're like, 5%, the G fund's only 3% or whatever. It's the G fund changes daily, but you see it monthly. Anyway, over the course of the year, you're going to get about 5% in the G fund,
which is
risk-free. Yeah, it's
right?
great.
Risk-free. Yep. Nothing bad's going to happen.
So if you're looking at all this geopolitical events going on, and you're like, I think this is insane to be in the stock market, I'm going to be in the G fund. Nothing wrong with that at all.
No. I mean, and we actually have said that many, many times over the years that we've been doing this. It's about your personal circumstances, your personal risk tolerance, your perspective, right? And that's the exact reason why you would go to the G fund, even if the market was going up. If you felt like all this volatility, for whatever reasons, is just not a good time, that's what's so great about the G fund. And people that kind of poo-poo the G fund, like, I just don't understand it. You can't make a lot of money in the G fund, but what you don't do is you don't lose money, right? And so we're a big fan of it. I mean, obviously we go back and forth in and out of it for that reason. Now, we tend to try as best as the indicators will give us, right? We'd like to be on the uptrend. If there's going to be a long uptrend, let's take advantage of that. But anything else, if you're not feeling that, there's nothing wrong with going to G fund. No,
100% not. So the thing about the G fund is, so you look at all these macroeconomic stuff and geopolitical events going on, and if you make your reallocation decisions based on that, you can't come to any conclusion other than the G fund, right? It's unreasonable to come, if you're just using those inputs, it's unreasonable to come to any conclusion other than the G fund. But as soon as you look at the price chart, you look at it and go, okay, all these things are going on in the world, but this is a really good support level. So maybe I'm going to get in, and if it closes below that support level, then I'll get out, because then I know that all these conditions have pushed price down, or prices responding to the conditions, or however you want to say it. And so that's kind of the risk reward that I really like. Like, I like it when the market is at a support level, because then I can make a reallocation decision. And I don't care if it goes up or down. If it goes up, great. If I'm on the right side of it, if it goes up, that's great. If it goes down, that's fine too, because I took a little loss, but the risk of the potential gain was significant. Right.
Yeah, and that little part you mentioned is what a lot of people get hung up on is, how you just said, oh, I might take a little loss, big deal. And other people are like, oh my God, I lost, a half a percent or 2%. Yeah, but listen to what we're saying about the risk reward here.
Right.
There are very few opportunities in the market the way it is for you to have those that sign, right? It's at a support level, which, if you listen to us, hopefully you guys know what we're talking about, right? So it's sitting on this level, kind of, maybe headed up.
Yeah.
We don't know, right? But the risk is so low because if it drops below that line,
Yep.
right? It lost support. If it goes up, great. Either way, I can always get out. I can always go to G. So all things considered, if it's way above that support level,
That's when it's riskiest.
It's still
for me.
going flat. Yeah.
Yeah.
Well, for all
Yeah.
of us, right? Because you don't know where it's going to go. It's so far from the support level that you would have to get there
Yep.
to prove it. It's
Yep.
that's a bad, right? We want it. We want a lot of things, but what we have is it's sitting on that support level.
Yep.
So, I mean, hopefully that rings true to folks if you're listening to this. Hopefully that makes sense. And a lot of times that's how we're not trying to catch the bottom, too. Don't mistake that. We don't know if that's the bottom. We have no clue.
Right.
All we know is the risk is it drops below that support level, meaning it's highly unlikely it's going up, right? If it breaks that, it's just math. It's going down, right? And so you get out. But you got to accept that little loss because we can only make the move by noon and, get that day's closing price.
Yep. And that's just one way of looking at how to play the TSP game.
Yeah.
So anyway, it was a really, really well thought out commentary of what's going on in the world, and it's all true. And there's nothing wrong with going to the G fund based on all that. And we're going to get to it, but what the chart looks like at the time is where the difficulty in making these decisions comes into play. So this is an example. So I think most people are probably going to recognize this chart. I blacked out the dates for now, okay? But if you're looking at this chart, somewhere in here was 9/11, 2001. Somewhere in here was the collapse of Lehman Brothers. If you had to, it's too bad you can't. Well, maybe you can tell me if you already know. But if you're looking at this chart, where would you think September 11th, 2001 would fall in this chart?
I mean, I kind of know but I can't see the chart like you can. It's a little video on my screen, so I could have tried.
You can't see it. All right. So,
yeah, you guys, I've got like all these little things on my.
I keep forgetting.
I can barely even see Jerry on it.
Nope, that's all right. So this is the top in 2000. This is the top in 2007, right? So that gives you a little bit of reference. But this channel, right, was the bear market from the top in 2000 to the bottom in March 2003. Then we got this channel as a recovery rally. And then we had 1, 2, 3, 4, 5 L8 wave count to the very bottom at 666 at the bottom of 2009. So where was 9/11, 2001? A lot of people, mistakenly say that 9/11 crashed the stock market, right? That's where it was right there. So did the market go down after 9/11? Yes.
Yeah, but look at
it went down.
Larger trend where it was headed anyway.
Right. It went down to exactly where it would have been to keep this lower channel line.
Yeah.
And it only stayed down there for a week and then came right back up. And then the recovery took us back to where? The upper channel line.
Yeah.
So the biggest terrorist incident, since Pearl Harbor had very little effect on the stock market.
Very little long-term effect. Again, we're always talking about this. It's perspective.
Yep.
If you have the ability to draw back, we get hammered on a daily basis by people that are only willing to look at yesterday and yesterday and today, right? They're just not willing to take a step back and look, last year versus this year. It's easy. I mean, we know that people are like that, so we don't really pay much attention to when people give us a hard time. But you immediately know when someone's cherry picking, when they'll just pick a part of time, one time, and say, well, look at this. And you go, okay, we'll take a step back and then look at it a little bit bigger, and you'll have a little bit different perspective. That chart is all about perspective to me, right? You think you know when, right? And I was looking at that, and I knew it wasn't the huge dip.
Yep.
But I can't see the thing very well. So I'm like, no, it's got to be. It's one of those little ones that's like quick also, right? Because it was like quicker than COVID.
Oh, yeah.
Like it just went down and up, right? Because we all rallied and we all got behind everything and we all, the market responded, and that's how it happens.
Yeah.
But the bigger perspective is it was on a downtrend long before that.
It was on a downtrend long before that. And not like, unlike COVID, it only rallied back up to the downtrend line and kept going and went much lower, right? And then we had this is a 1, 2, 3, 4, 5. That's an impulse wave, okay? This ABC is a corrective wave. It's correcting this move down, okay? So over time you get to see how the wave like looks. This is an impulse move to the downside. This is an impulse move to the downside. This is just a correction of this down move. So if the biggest terrorist incident since Pearl Harbor doesn't really bring the market out of a trading range, right? How does the collapse of one bank in the United States cause the great financial crisis around the world, right? From the top in 2007, we're at, I don't know, say it's 1,600, and we get down to 1,260 at Lehman. So what is that, like 25%, something like that? I mean, we had a 25% move to the downside before the collapse of Lehman Brothers. And then from 1,260 to 666 is another 50% move. So the collapse of Lehman Brothers actually did have an effect on the market. And it should, right? Because the stock market is a financial institution, and when one of the biggest, institutions in the overall financial institution goes under, it's changing the whole system. Whereas a terrorist incident, given it's the biggest one in 100 years or whatever, it didn't really change anything in the big scheme of things. But this did, right? So some news matters and some news doesn't matter is the bottom line. Okay, but yeah, a lot of people, first of all, don't understand really what the impact of 9/11 on the financial markets. I mean, this changed the world in the big scheme of things. This changed the world. They just had to get up and push forward. Was it $780 billion to correct the problem, right? And then we got to a bottom in 2009 and kept moving higher. We're still living with this problem, All right. So awesome question, and nothing wrong with being in the G fund, but we're going to get to that again too. So we had a comment. Learned a lot from you guys, from your content. I'm becoming more comfortable assessing the charts on my own to make reallocation decisions based on my personal circumstance, based on my personal risk tolerance. I reallocated to the C fund as it found support at the 200-day moving average line. So he's a subscriber. He was obviously watching the last members only webinar and the last 2 newsletters, and we did a market update about this over the last week or so. But this was the chart that we did on the members only webinar. The webinar itself, I think, was September 28th, but I did the charts from September 27th. And it's a daily chart of the C fund. And you got the 200-day moving average line. You can have either an exponential moving average or a simple moving average. So exponential just means there's a 200-day moving average, simple moving average. They just take they add up the last 200 days of price and divide by 200, and that's how you get the average. Exponential gives a little bit more weight to the most recent price. So most of the time, like back here, they're very close together. And then when big things happen in the market, you get some divergence between the 2 moving average lines. So all I did was plot those two moving average lines on the chart. And I'm like, somewhere in here between the exponential 200 and the simple 200, and we got this 4,200 to 4,300 zone that we've been talking about for over 6 months, we're very, very likely to get support in there somewhere. Okay. And there's some other things that you can point out. If you're doing an Elliott wave of this, you can call this a 1, ABC2, 3, ABC4, and then you're expecting a 5, right? You're also going into the fourth quarter and the third year of the presidential election cycle, so there's all kinds of reasons that you should get support here. We didn't have a buy trigger, but there's all kinds of reasons to get support there, right? So this guy comments in and says, hey, I get what you're saying, and I got back in the stock funds when it hit that 200-day moving average line. And that's what we were kind of banging on the table about over the past couple of weeks.
And that's exactly what we want people to do. I mean, that's a lot of people are not hearing us when we say it, but I don't think this stuff is that hard, right? It does take some time. It took me time, right? Sitting around with you, learning this stuff and then learning it on my own and trying to figure it out and applying it to not only the TSP fund, but being able to apply this to, lots of other opportunities, right, outside of the TSP. It works.
Yep.
So there's a reason why so many people do it. And you just got to learn these little, you got to learn what works for you and what you're comfortable with, right? And that's a great version of that, right? Where this person saw something like, moving averages, the channel lines that Jerry just drew, like all of these things, if you layer them on top of each other and they're all telling you the same thing, there's a high probability that that's what's happening.
Right. And the good thing is, if the higher the probability that happens, obviously the higher probability it happens. But if it fails, that tells you just as much information.
Exactly. Yeah. And you learn from it.
Yeah. Okay. So I think this is the last one of these. We did an alert earlier this week. I guess it was early in the week. And the percentage was very heavily on the C fund. So the question was, could you review, expand, maybe on the weekly show, on how the C fund was stronger? Because I was saying that we were going to be, the C fund was a much stronger looking chart than the S fund. So I know you touched on it in prior information, but when I was looking at both yesterday, about 20 minutes before the cutoff, it looked like the S was also above the 20 simple moving average. RSI at that time was just above 50, barely, okay? And the others were positive, so I went 50-50. So he went 50-50 C and S. Nothing wrong with that, but I was saying I guess it was the alert, that the C fund was a much stronger looking chart than the S fund. So this is the chart that we put out at the time of the alert. And this is the C fund, okay? So this is the 200-day moving average line in red, the 20-day moving average line in blue, and then you get the technical indicators at the bottom, right? So we have this ABCD, right? So the length of A to B is the same as the length from C to D. That was hitting just above the 200-day moving average line. And we also have this, 1 ABC for 2, 3 ABC for 4, and we're expecting a 5 wave. So I'm looking at all these things, and I'm like, and then the buy trigger on that day, price closed above that 20-day moving average line. RSI got above 50, CCI got above 0, and MACD turned positive. Okay, so that's our buy trigger. So we were just talking about how this level down here we expected support there, and the buy trigger confirms that support level, right? So that's why the alert came out. So that's what the C fund looked like. The S fund. So in the C fund, you see we had this big move down. This is the top in 2022. Get down here to the bottom in October 2022, and we're almost, I don't know what the percentage is, but we're pretty close. We were anyway at the end of July, pretty close to making new highs, right? The S fund is nowhere near coming back to new highs. I mean, it's got a much longer way to go. It's been basically in this sideways channel since, July of last year. S fund hasn't really done anything. And if you look at it kind of on a detailed level, it was below that. We talked about how support at that 200-day moving average line in red on the C fund, right? We were above it. It was holding as support. On the S fund, it had been below it for several weeks, right? So now that 200-day moving average line is acting as resistance. The 20-day in blue is coming down and it's crossing the 200, right, which is called the death cross. And we got, it's kind of hard to see here, but we got a couple of days of resistance right there. And so that's not a great looking chart. It's much weaker than the C fund. So that was why we did not include the S fund in the reallocation. There's nothing wrong with doing percentages that are different than what we have in the model portfolio, but that's why we didn't put the S fund in there. Okay. And then the last piece of that, if you want to decide whether or not you want to be in the C fund versus the S fund, you do a relative strength chart of the C fund, SPX, divided by the S fund, DWCPF, and that tells you if the trend is up, it means the C fund is increasing relative to the S fund, right? So this is a relative strength chart. So all this really is telling us is that from November of 21 to May of 21, the C fund way outperformed the S fund. Okay, they performed about flat, about the same here, and then here the S fund way outperformed the C fund. Right, but overall, the C fund, the long-term trend anyway over the past couple of years is that the C fund is outperforming the S fund. So it's a pretty good. The relative strength chart is a really good way if the market as in general is going up, and you want to be in the one that's going up more than the others, you do a relative strength chart to figure that out. Okay. All right. TSP fund charts. So just a couple things I wanted to kind of point out about this. So we do the weekly charts. This is the 20-week moving average line. It's a C fund, and you can see I only went back to sometime here in 2020, but every time price comes down, it generally finds support at that 20-week moving average line until it doesn't. That was the big breakdown in January 2022. And then if you're below that 20-week moving average line, that's when bad things are happening, right? You don't want to be in the stock funds when price is below that 20-week moving average line. So where we are right now, we've been below that line, closed below that line 1, 2, 3 for 4 weeks. Okay. So we also have this 4,200 to 4,300 range that's been it's significant because this was the high in August of last year. A lot of things are revolving around that high from August of last year. So the 4,200 level was a big breakout from this cup and handle pattern. That was significant, and we got back above 4,300, and we've been there for a while now. And so it makes sense that there's a lot of churn in this zone right now, and that's what's happening. There's a lot of churn in that zone. 4,200, if we get a weekly close down here below 4,200, we are on a decline. As long as we stay above 4,300, we can inch back up here to new highs. This is a really, really important zone. And so if you don't want to play around, be in the G fund. As long as we're in anywhere in this area. If you want to take on more risk, be in the stock funds until we get a close below that 4,300 level, 4,200 level, sorry. And you can see right now we've been fighting, price has been fighting to stay around 4,300. Usually, in all these examples anyway, once you get a solid break to the downside through that 20-week moving average line, price keeps going lower. We're not seeing that right now, right? It's not collapsing, and this week especially. I mean, it's not a great week because obviously it came up and got rejected at that 20-week moving average line. But given all the stuff that's been going on in the past couple of weeks, it's amazing that it's held up as it has. All right, so that's what the C fund looks like. S fund again. It's just a much weaker chart, and we got while on the C fund, we're hanging in there just below that 20-week. The S fund, this is a big break down to the downside in the S fund, and it's got 4 continuously lower weeks. It's a much weaker chart than the C fund. The only, well, not the only, but what I would be looking at right now, this is the low from October of last year, and so if you connect the trend line, can we get back above that trend line? I mean, the S fund's not looking good. It's just not. I fund is worse. I fund was really good last year. Every time it came back up and rallied and hit that 20-week moving average line, it got rejected. Never got above it. And then we had this big breakthrough to the upside, and it kept going higher. So that's what we're looking for. And we're, like Conan said, we're not trying to catch the bottom. You have no idea that this is going to be the actual bottom. You got lower highs, lower lows. This was the lowest low. What would make you think that this next move higher wouldn't get rejected there and start moving lower? Well, what would make you think that is that candle right there. It didn't do it. It broke through the upside. So that's when you knew things changed. And everybody wants to say, well, you guys, we missed out on this whole gain. You weren't going to get that gain. It's impossible.
Yeah. I mean, if you were in a brokerage account that you could make instantaneous changes, maybe, right? You might
this is on a weekly perspective.
I know this is weekly, and you're not going to catch that. You're not going to know. No. Every part of that chart going backwards, what Jerry just showed you, it came back down. There's no reason. Well, how many times did it do it? 1, 2, 3, 4 times in a row.
Like every single time it hit that
it
20-week moving average
so
line.
There's no reason, right, to do that.
Right here, on this week, it was setting up for the exact same thing that it had done for the past year? Here's September of 21, and here's September of 22. So for the past year, you kept making lower highs and lower lows.
Yeah, if you think you should have caught that bottom and figured that out, you should play the lottery.
Yeah,
because it's the same thing.
Yeah,
right. It is, and I mean, we're not trying to beat up on this, but it is just like it's something we hear a lot of, where people are like, well, why didn't we do that? And like, how would you know?
Right.
Like we're not trying to look into a crystal ball. Now, once it breaks that line, like Jerry, I'm sorry, I don't have the chart up there, but once you break that line, well, now I gave you something to believe in. Really?
Yeah.
Right? Yeah. It gave you information that said, oh, well, things have changed.
Yep.
There's no way to know that until that happens. Otherwise, it's going to bounce off there and go right back down.
Yep.
And
so
that's the way it works.
Where we are right now, we're below that 20-week moving average line. The most significant amount of time we've been below it since this low. So, I mean, the iFund chart is not looking very good right now. Like, it's a high risk entry from my perspective at this point. If you got into the iFund now, I would love to hear why. You could say that, well, we had a reversal week here and we're above this low. So if I'm in the iFund, I'm not selling unless price gets below that low. Say it gets down here to 65. That's reasonable. You could look at it that way. We got this frowny face, as JC calls it. We had a run up. We had clear resistance here at that 74 level, and now we got lower highs and lower lows. So the immediate trend is certainly to the downside. The iFund is just not looking good. F fund, basically the same kind of thing. We've done some special. We did an F fund special in I think March, and we just did a market update special kind of thing on the F fund and the VLGSX and the mutual fund window. If you guys haven't already seen that, go to the dashboard and check it out. It's a good market update because at some point rates are going to get so high that something's going to break. Fed will push rates down. When rates go down, the price of the F fund goes up, and the long-term Elliott wave of this, we're not even. This doesn't even go back to the prior high on the F fund, but this is the 3, this is the 4, and we're in the 5th wave down. So at some point, we're looking for a bottom in the F fund, and then we should get some kind of significant ABC correction to the upside. All right. So we focus on the weekly charts, and a bunch of learning points on the show. That's the idea. But if you guys want, every week we put out this newsletter. It goes much more in depth on the daily charts and different kinds of analysis. We do the special updates and then the real-time, notifications to changes in the Grow Model portfolio. Sign up at growmytsp.com. Questions?
If you have any questions, you can always shoot them over to us through email, support@growmytsp. The best place to put your questions is wherever you find the content. If you find this video on Facebook or, on YouTube, just throw a comment in there and, we'll get to it, or support will get it to us, and, might end up on the show with a question. One of these days, I'd love to try to figure out a way to do these like a live call in.
It would be awesome.
Even if we just did a call in during the recording and it recorded it all, because that would be fun to actually talk to some of these folks that have these great questions and go a little bit back and forth. Let us know what you think about that, guys. If you think that would be cool or not, or if we're just being old school. I'd like to be like a radio show.
Yeah. Radio call in.
Yeah. All right, guys. I hope you have a great week coming up, and we will see you next time.